yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were known to the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter that said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance and asking for forgiveness from my
we've received dozens of messages from people whom are telling their own sort of personal tales of, kind of financial advisors gone bad or family members who got convicted. It seems that it resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself. But at the end of the day, they did wrong.
Life lesson. Beth, you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce, in 9 trades, a guy called Cuddles made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to 8. It went further than anyone had expected. So lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually, in a bid to sort of push? So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by
the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. Some of them came from Essex.
400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top three. Amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was kind of death knell for the pits. And in 2005, the IPE closed.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain, a kind of Essex person, they would see someone slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Theda is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. Basic online searching, it's very difficult to find anyone who's public with the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same
barrels of oil to you at this point.
It's actually just a financial contract to gamble on, to predict. Essentially what they're doing is buying contracts, give them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're the oil will fall throughout the day.
But selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout the price dropped and dropped.
So this is well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly, there's a kind of buyers and sellers, as desperation increases in the market and trading volumes go. 2:08 p.m. something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of -$38.
We've never seen any period in terms of the contraction of the global economy.
Gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit, the difference between -37 and all of these positive numbers on every contract they sold.
The price of
trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
Risks, and you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trade, simply aren't willing to stomach the. But Cuddles and his friends were.
So when the kind of regulations came down, a group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing about doing to making $100 million in a 6 days trading. When me and Liam discovered that, we couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them
that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average meant, if you imagine, countries like Saudi Arabia, Kuwait potentially lost a barrel of oil.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I understandable scrutiny.
To Vega traders who did exceptionally well that day. We got a letter in response from a who represent.
What I love about these stories, there's a real variance of opinion, and some people will look at that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people were shocking. Some people say these guys are at acute disadvantage. Huge driven funds and firms, and a lot of the guys have stopped trading. So when past, several of them have set up new companies. They've essentially gone very quiet. The media presence they had has kind of closed down. By all accounts, they're waiting this out.
Did exceptionally well that it's day. Certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know the outcomes of these guys. Potential if any findings of manipulation against Vega or anyone affiliated with it you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been with all the money that they made and celebrated as heroes in the trading community. They'll go down as legends. It's certainly too early to try and predict how the regulatory investigation is going to pan out. We just don't know outcomes of these guys. Any findings of manipulation affiliated with people be fined, banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who we just don't know outcomes of these guys.
Very important given the nature of the climate crisis right now for the general public to have an understanding of what's actually happening. And I think they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, and the reality of the matter is we're just on a trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that setting out to climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who are willing to candidly talk about it. The best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the 1988 years. I was actually hired by the World Resources Institute in Washington to when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an person, that factory on the other side of the planet, to reduce their emissions, then you are, in a sense, offsetting your emissions. And the atmosphere doesn't really see your emissions anymore.
So around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with what policies and measures might become like on climate change more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net.
We can achieve a net zero emissions.
We began these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land. It will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, they can help fund important work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
20 new reasons to visit this year.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies, major reductions in their carbon footprint. Very difficult to change the fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot actually about a 3-hour drive. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do for all of these years, which is they go out, they raise money from local buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said these threats have been abated because of this acquisition by the Nature. Really interesting now, fast forward 2 decades, earlier this year, when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, it's just astounding because this land is owned by the Nature Conservancy, land that they bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint, credible or truthful claim. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive was decades to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, has resulted in is claims of climate progress that just really happening. The Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves. They're setting up the rules which allow vapid projects and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy set up and sold on this exchange is called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. Carbon offset project has to follow, but there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting.
One of the challenges with designing carbon offset systems, two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to make a lot of things happen. And the challenge is that both of them are the same thing. Because that works for their business model. You end up, though, with policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon in the sense that they can help mitigate climate change. We can, but you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just we're sort of nibbling around the edges with these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation from city to city.
29 New York to D.C., 30 San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop. Incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation, can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is make it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is, like, we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in space normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost,
and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on.
The ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditionally fast as well. And outside China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in hours. Net result is the city regions, Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that Metro Hyperloop network is connected to other networks, you could travel to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly. For high value and logistics, it's critically. If you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and off the roads. That means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and technology that could be used. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
Full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over, take Europe, for example, with the same ease as you can now travel with a metro in the city.
This magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up and steps split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail, even modern magnet one track to another.
And this is an element because this is the thing that limits the capacity and in the end the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it pushes that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. This stuff, most of those are proven systems. Health is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspect, feel comfortable with such a system. Different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, Hart in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for Hart is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel. You don't want to end, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, those can all be.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network, because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own, unless you have the governments. And I think in that sense, we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced a long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming as people move forward.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, the moment at which those 2 human beings traveled that short distance down the tube, that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. Why the universe's most element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable.
Let's take action. Practical, implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg reporters in New York, I'm Haley Lyons, and this is Bloomberg Green. It's a new year, so here at Green, we're highlighting new solutions in the fight against climate change. This is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter?
The most plentiful element. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. The way to do this is via chemical natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning, it negates the zero emissions goals. With fossil fuels is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis, powered from renewable sources. It is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of are already used today. 2008, 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties at a time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote his book, The Mysterious Island. The future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion this fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old. Its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record. Fortescue sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right? Then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. Every other form of fossil fuel hydrogen, it can compete with it on price, it can lose on price, but what we know, it is cooking and only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call to fund any more coal-fired power stations ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
Hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times the methane, which is worse than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being at multi-billion-dollar scale. If they'd known that, I don't leader or energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition? Because we're at real of missing our targets.
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we push down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. Blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the honestly. Well, not that honestly. Measure methane, which is 90 times. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost.
Need to be cheaper, oil and fossil fuel worldwide.
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know.
Mr. Force,
we've had big business is transacting with green hydrogen in multi-billion.
Just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This From Bloomberg, and wind power homes around the world. According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen 2050. Results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 an hour. 2010, 600. Today, 100. I see it going down to 50 and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of energy, hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you speak to governments, when you speak to officials, are they keen on this?
So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. Australia is very big on hydrogen. Japan is blending hydrogen. So I would say the world is really focused on this. The way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
Then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, diesel to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very degrees. So I think a lot has been the G20 COP, and I think what's really important to see in the coming years, how quick in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where...
CEO of SNAM there speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's manufacturer, is stepping up the challenge.
Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines are under growing pressure to ramp up short-term innovation to cut their carbon. In the long term, meeting the green building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation decades leading up to the pandemic about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up from Blue Sky Pro, we'll Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's world headquarters in This is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the energy mix globally?
The suitable solution for us as we look to decarbonize, because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That it can be used for such. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated. It can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Need storability, where store hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more storage to handle the same amount of energy.
Let's talk about the viability and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks holding at or near session highs, and this update brought to you by Commonwealth, supporting more than 2,000 independents they need to grow a business. Commonwealth, where you grow. Visit .com to learn more. Stocks jumped after Fed Chair Jay Powell said the U.S. economy is expanding with enough force to withstand interest rate increases while pledging to be Bloomberg Radio.
The near-term effect on the U.S. economy of the invasion, the ongoing war, sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected.
Yield at 1.85%, up 87, up by 2%. The Dow is up 670, up 2% as well. Nasdaq up 218, up 1.6%. Spot gold down 1.2%, 19.22 the ounce. Crude oil surging 6.5% to 110 a barrel right now. Katie Kaminsky is Chief Research Strategist at Complex, and she says investors cannot ignore what's going on there.
I mean, this is serious. We've seen a massive move, and all of these price increases are going to trickle down at some point. We already had a massive headwind of inflation on the commodity sector. This is really going to put even further, yet another asset where we've seen sort of movements in terms of. And all of this is just going to eventually create some challenges for other sectors of the economy.
After earnings, Nordstrom surging 37%, Salesforce.com up by 0.9%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
This is Bloomberg. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from Bloomberg headquarters in New York. Good afternoon to our audience around the world on Bloomberg Radio and on YouTube. It's Bloomberg Business Week. I'm Tim Stenovic. Carol Masser is on assignment today. Joining me now is Bloomberg Cross Asset senior reporter Kitty Greifeld. She's also my co-anchor of Bloomberg Quick Take Stock. It airs each afternoon on Bloomberg Quick Take. You can catch us at noon. Today, all about Powell, the chair of the Federal Reserve, just wrapping up the first day of testimony on Capitol Hill. Today, in front of the House Financial Services Committee, investors certainly liked what they heard. We're going to have more on that in just a minute. Also, shares of Hewlett-Packard Enterprise are surging today after the company's most recent earnings report. We're going to hear from HPE CEO Antonio Neri and the CEO of the fuel system developer Plug Power, also for an update on the company. And the latest on the war in Ukraine with one of our reporters who's in Eastern Europe. In the magazine, the heir of billionaire Thomas Peterffy is hanging up his healing crystal to fix capital. And today's big take, the Credit Suisse strategist who says the U.S. dollar has reached a critical inflection point. We wrap up our program with the author of a new book about the foundings of PayPal. Tony joins us. He spoke to them all, Elon Musk, and more. First, let's get to the Market Drivers Report. With me now in the Bloomberg headquarters is Kriti Gupta, markets correspondent at Bloomberg, and Yelena Shalietova, senior U.S. economist at Bloomberg Economics. She joins us on the phone from. Good afternoon to both of you. Kriti, I want to start with you and just go through the difference of what we see with the market, with the equity market, at least today and yesterday. Is everything positive that we're seeing, the optimism that we're seeing, is it all about Powell?
No, actually, it's really not. It's actually very technical, to be completely honest. So when you see moves like this, a 2% rally in the S&P 500, it's pretty normal to kind of assume that this is more a function of volatility and bouncing back than it is of any fundamental reasons like Chairman Powell.
Really?
I believe we had Scott Bauer on Bloomberg TV the other day. He came out and he said, well, if you're looking at a VIX at a 30 handle, which, by the way, the VIX is at a 30 handle today, 0.5% move in either direction. And when you have a VIX that high, you can't necessarily count on these gains to really sustain. You want it to be kind of more calm, more gradual. That means it's going to stick around. And if you have a much more positive message from the Fed, that's when you know that a 2%, it wouldn't necessarily justify a 2% move in the S&P 500. Also keep in mind that oil is higher today. Yesterday, every time oil went higher, every ticket went higher by, the stock market dropped in line with that. So you know the stock market is still very sensitive to those inflationary pressures, and specifically in the oil market as a result of those geopolitical tensions. So there's a lot going on here. I wouldn't just pin it on Powell, although the fact that he said that he's looking for a 25 basis point move is certainly good news.
Well, let's dig into that because we do have the March Fed meeting coming up. This is one of the last chances that we will hear from Fed officials. And Yelena, we heard Powell say nimble a few different times. They're not going to be on autopilot. They're going to move carefully. They're going to be nimble. What does nimble mean in this context?
It just means that uncertain further. So I think the market's actually taking, Powell's speech as a bit hawkish. There was 4 basis point move in the 2-year yield, for example, as he was speaking, as he was delivering his testimony. But it's something we kind of predicted that would happen. First of all, the 25 basis point move in March that Powell basically confirmed. And the possibility of further 50 basis point hikes at upcoming meetings, inflation does not improve from where we are right now. So I think Powell saying that the Fed can accelerate tightening actually shows the markets that the Fed could be a little bit more hawkish down the road.
So, Yelena, is the market taking that in stride, that it could be more hawkish down the road?
Yes, I also think that if the Fed wasn't data dependent, though they are even much more data dependent at this point, as uncertainty surrounding the war in Ukraine is actually the Fed will just see whether the situation with oil prices and energy prices in general will affect the U.S. consumer to a larger degree than it affects inflation to the upside. And based on the outcome, they will act. They will be nimble.
And Kriti, I'd love to hear your perspective that we're seeing today, 2%. I mean, how much stock can we really put into that, given just the whipsawing that we've seen? And if you look at different measures of hedging, it feels like really traders are hedged to the gills here. I mean, how much conviction is really behind these moves?
Yeah, I think you nailed it here. You count on this as a healthy recovery. As we started the segment off with, I think you also have to keep in mind that the dollar is under a little bit of more pressure today, which tells you that cross-asset, take oil out of the picture for a second, but cross-asset, even in gold, you are seeing just a reversal of some of the moves you've seen in the last 2 days. And sometimes it's as simple as that. It's just a reversal. What you really want to see is that sustained growth. Now, we've only seen 1 day after a sea of red, so we got to keep waiting.
Okay, well, what do we keep waiting for, Yelena, in the last 30 seconds that we have with you?
Well, the Fed made it very clear that they know what their job is right now, and that job is to reduce accommodation. So next stop is the Fed meeting, and before that,
April recess. Hearings begin March 21st. Congress is moving forward with funding the federal government with a supplemental bill for Ukraine. Bloomberg's Amy Morris has the update from Washington.
Lawmakers are putting together a three-part spending package to include aid for Ukraine, COVID-19 relief, and a 12-bill government funding package. They're trying to get the whole thing passed by the end of next week, which is cutting it close. The deadline is March 11th. House Appropriations Chair Rosa DeLauro tells Bloomberg Radio that a Ukraine aid bill could be as much as $10 billion, well beyond the $6.4 billion that the White House requested. In Washington, I'm Amy Morris, Bloomberg Radio.
Ionic smartwatches from Fitbit are being recalled. The Consumer Product Safety Commission says the lithium-ion batteries could overheat and pose a burn risk. So far, there have been nearly 80 injury reports so far. If you own an Ionic watch, you're entitled to a refund of $299 and a 40% discount code. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Thank you so much for that update, Nancy Lyons. Tim Stenovec and Katie Greifeld live at Bloomberg headquarters in New York City. Katie, we're going to have a lot on the crisis in Ukraine, Russia's invasion of Ukraine throughout the program today. One of the most read on the Bloomberg terminal right now is a story that we just learned about in the last hour. There's been a lot of speculation about what the oligarch Roman Abramovich is going to be doing with his Chelsea football club, and we're actually finally getting some news.
Yeah, news today that he is selling Chelsea Football Club, and he has also instructed the board to set up a charitable foundation that will receive all of the net proceeds from the sale. There had been a lot of questions over it, so interesting to finally see some headlines around this.
You see oligarchs right now scrambling with their jets, with their yachts, with their assets around the world, trying to avoid them being seized as Russia invades Ukraine. For Roman Abramovich's part, he said in a statement, quote, "The foundation will be for the benefit of all victims of the war in Ukraine." Really interesting wording of that statement. All victims of the war in Ukraine. We have to remember that there are obviously also victims in Russia throughout this war that is being ordered by Putin. And I also, it's interesting to hear the term "the war in Ukraine" being used by this oligarch. You have to also wonder what this means for other really incredibly wealthy Russians around the world and their assets and what they're doing to them right now.
Absolutely. I mean, the UK, it's sanctioned more than 100 Russian individuals and entities so far. Abramovich, of course, he has remained off the list so far. Just for a little background, he made his fortune from dividends and sales of privatized assets acquired from the former Soviet Union.
He bought Chelsea back in 2003. He pumped enough money into the team to turn them into serial winners, with the club claiming last year's UEFA Champions League title. He put plans to redevelop its stadium on hold back in 2018 after running into problems renewing his UK visa. This came amid escalating tensions with Russia. That year, he actually obtained Israeli citizenship. He's worth about $13.5 billion. That's according to the Bloomberg Billionaires Index. This is Bloomberg Radio.